All right, guys, welcome back to Father and Son Investing. We're going to continue our series on artificial intelligence ETFs. Today, we're talking about the iShares Robotics and Artificial Intelligence Multisector ETF. It goes by the ticker symbol IRBO. Now, just to recap, the first video that I did in this series was sort of a bird's eye overview of artificial intelligence investing. Then we talked about ETFs, BOTZ and AIQ. Those are both by Global X. Next, we talked about ARKQ, that is Cathie Wood's ETF that concentrates on robotics and innovation. And today, then, we will cover the iShares IRBO. All right, what does IRBO have to say about investing in robotics and artificial intelligence? Well, they view this potentially as the fourth industrial revolution. They see the mass adoption of robotics and artificial intelligence that could become the fourth industrial revolution after steam, remember the steam engine, mass production, and electronics. Now, this would likely affect every major industry as global spending on AI alone is predicted to double in 4 years, reaching $110 billion in 2024. What are they looking to accomplish? Well, they want to invest in disruptive change, so they want to have exposure to companies at the forefront of robotics and AI. They're looking to harness technological growth. Now, the way they go about doing this is they use a global equal weighted index comprised of companies specializing in innovation across robotics and AI, with growth really being the theme here. If you're in this to receive a dividend, you might as well go look somewhere else because their dividend is a paltry 9 cents. Now, they go into depth explaining their index methodology. I will just briefly try to summarize that by telling you that they are using an index provided by another company. Now, this index is reconstituted annually, and they rebalance their ETF semi-annually. Why is that important? Well, let's look at the expense ratio. It's 0.47%, which is certainly less than the other ETFs that we've talked about so far. But I really view this more as a passively managed fund. They're using an index. They try to replicate that. The index is reconstituted annually. And with their semi-annual rebalancing, okay, maybe a little bit actively managed semi-annually, but you're paying a lot for essentially a passively managed fund. Remember, VGT, which is a passively managed fund, 0.1%. Now let's just look at where the equities are coming from around the world with IRBO. You're getting about a 50-50 split between the United States equity and non-US equity. To break that down even further, of the non-US equity, about 33% of it is coming from Asia and about 11% from Europe. About 85% of it is coming from the developed world, or developed markets, I should say, and about 15% from emerging markets. And when we're talking about emerging markets, those are really coming from Asia. About 14% of it is Asia emerging, with about 1% being Europe emerging. Just a very small exposure to Africa and the Middle East, a little less than 2%. Now let's just quickly look at the holdings. Remember that this is going to be equal weighted. So you're going to be looking at about a little more than 1% to certainly less than 1% of each of these 120 companies. Compare that in contrast to ARKQ, where you were looking at about 11% just of Tesla itself. So when we're exploring these holdings, we're going to see some that aren't as well known, as well as some that are very well known, such as Snowflake and Adobe and Teradata. The highest percentage is going to be Ambarella at only 1.4%. The lowest equity holding is going to be Henkin Networks at 0.37%. What do the year-to-date and one-year returns look like? All right, year-to-date, the AI and robotics area has certainly taken it on the chin a bit compared to the rest of the market. We're only looking at about 12% total return for IRBO. The best in this area for the ones I've listed is going to be VGT at about 21%. Take that out to 1 year and we're looking a little better, about 32% returns for IRBO. That is certainly behind the leader here, which is ARKQ. That is Cathie Wood's ARK Invest ETF. Taking it out 3 years, you're looking at about 21% return. That is in the 76th percentile. and still certainly behind ARKQ and VGT, which are 12th percentile and 28th percentile respectively. Looking at it another way, if you had $10,000 back in June of 2020, that $10,000 would now be worth $16,000 and some change. That certainly is behind ARKQ, which is just shy of $19,000. All right, so what's my take on IRBO? I already mentioned my concern about the expense ratio. While it certainly is less than ARKQ, BOTS, and AIQ, which we've already covered, remember that this is essentially a passively managed fund that's rebalanced semi-annually, and you're paying a significant amount for not a lot of work on the part of IRBO. The fact that it is equally weighted may appeal to many people. You are certainly getting a broad spectrum of companies, which allows you to diversify significantly and thus can limit a lot of the risk that comes along when ETF holdings become very concentrated, such as Tesla with ARKQ. You certainly are getting a broad spectrum related to artificial intelligence and robotics. You've got robotics developers, you've got robotics enablers, you've got AI developers, and AI enablers. In general, the returns have been good, with the exception of YeartoDate so far, but that seems to be the trend among all of these ETFs. And I like the fact that it's about 50-50 of U.S. equities and equities in the rest of the world. And I do like it's roughly 15% of emerging market equities. Am I buying IRBO? No, not really, and that's basically because I've already bought some of ARKQ and BOTS and AIQ, as well as VGT. If I'm going to pay almost 0.5% for a fee, I want my fund managers to be working a little harder, I think, than what these guys are doing. I hope this was informative for you. If you have an alternative opinion, please feel free to leave that in the comments. I'd be interested to hear what you have to say. Until next time, enjoy your investing.